So, good evening, or afternoon, morning, wherever you're watching this from. Now, we are going to the next session of this training. This one we are is the second episode or the second session, Forex 102. Before we began, we had a question. Florence had a question for us that what is the meaning of the candles, the red candles and the green candles. So what I was trying to explain is that the green candles represent the long position, the buying positions of the markets, meaning that I draw to our attention that we have two animals, I like to call them, that are represented in Forex. One of the animal is the bull, B-U-L-L, because they are going up. It's the bull. We are buying the market. Anytime we say the market is going up, it means that the bulls are in control of the market. And whenever the market is coming down, we say the bears are in control of the market. Bears, B-E-R, BEAR are controlling the market. So the red candles that you can see as they're coming down right now represents the control of the bears. The green candles, as you can see, going up represents the control of the bull. Now, I also mentioned that some people decide to use blue as opposed to green. They can use the blue to represent the bullish market, and they can use white to represent the bearish market. But here in my Billions Academy, Trading Academy, we tend to use green and red, but it's entirely up to you, whatever is works with you best. So, but this particular session is quite it's beyond this syllabus for now. We'll treat this on a later session, but for today we have this one for you, Forex 101. So we'll start with what they call the PIP. The PIP is one of the most important things in Forex, because this is how we measure whether we are making money or we are losing money. This is our currency, so to speak. Now, it's defined as the unit of measurement to express the change in the value between two currencies. So it means when there is a change, because I told you last time we met that there are numbers that are involved in currencies, 1.057 whatever. So when you have two numbers paired together, let's say for instance what we have on our screen now, 0 USD. There are numbers that are there that you either subtract together. You subtract together to be able to know what is the PIP, what is the difference in the movement, and that difference is what is going to determine how much you are going to be making or losing in the market. That brings me to reminder that I have to let you know that you don't always win in the market. There are situations where you lose money in the market as well. So Forex is a very high risk environment, a very high risk industry. So it means that you cannot just jump into the market if you are not sure that that position that you're about to take is going to win. So you have to, number one, be able to protect yourself. The way to protect yourself, we'll talk about it later. And another thing is to have a good risk management. Don't over leverage. Don't trade too much. Don't gamble. All of that will put into your knowledge, so you know how to enter the market, when to enter the market, why you are entering the market, and with the assurance that you're going to win in the market when you enter the market. Now, let's say for instance, you have okay, first, before that, most currency pairs are priced to 4 decimal places. That is what it is, 0.001. They are priced to 4 decimal places. I'll show you what I mean by that. Now, if I come here, most of them are priced to 4 decimal places, some to 3 decimal places, some to 2 decimal places. Now, another thing is that it depends also on your broker. Your broker can price theirs to 5 decimal places. So, but you look at what we're looking at right now. This is from XM UK. XM UK is a broker. They have this as their currencies, their prices for these currencies. This Euro GBP. This is the price. This is, I know there's a bid price and an ask price. We're going to treat that later also. This is the price. So if you count it, it's to 5 decimal places. So that's 1, 2, 3, 4, 5. But the one that is really key to us is the first one here. We don't really talk much about this fifth one. This fourth one here is called the pip. It's called the pip. It's called the pip. So the fifth one here is what is called the pipette, but we don't really deal with what they we deal with the pipette. So if we're making any calculations, we are only concerned about the four numbers here: 1, 2, 3, 4. This 4 decimal place. This last one, we don't really bother ourselves about it, but you will see how this comes into play. Now, let's say you have Euro USD equaling this number. Like I said, this number here is the yellow one here, or the orange one here is the pip. The number 8 here is the pipette. But we don't, like I said earlier, we don't really deal much on the pipette, Now, the only other one that deals with 2 decimal places is the JBP pairs, the JPY pairs. That's the Japanese pairs. Like, look at this chef. How many decimal places? Like I said, some brokers will always add an extra decimal place, which is not needed for our own calculation when we need to make calculations. So you only concentrate on these 2, 1 to JBP, like chef JPY. The only one we'll concern ourselves with is 0.35. Audi JPY, the only one we'll concern ourselves is 0.16. When we start using these numbers, you will see how they come into play. But just know that PIP is the currency of Forex. That's how we measure our currency. That's how we measure our currency. Difference between two positions, for instance, you find out in the later stage. Now, there's another element in Forex which is called the lot size. This is your position size. This is how the stake that you enter the market with, because Forex is all about putting something down to make something. It's like making an investment to receive a return. So now there are numbers that are involved in that investment, and there's a general account balance that you need to have on your what they call the broker account before you can trade. You can't enter the broker account without money. Enter the market without money. It needs money. You need to put money in to be able to take money out. Now, the positions that you can see on here as the positions that have been put down in the market that would help you to determine how much you want to put in as a stake in the market. The standard lot position, this number is denoted with number 1 in the market. If you enter now, we'll show you how this play out when we go in. Remember, Forex is more practical than theory. All of this is just to give you the ground with the foundational knowledge, but then it's more hands-on. You do it with your hands, So the number of units is 1,000, 100,000, but you don't really need to bother yourself with that. The mini is 10,000. The micro is 1,000. But what I can really say is that if I want to break that down a little bit further, it means that for you to be able to take a position in the market, you must have at least 1,000, a standard lot position. You must have at least 1,000, $100,000 or pounds in your account, to be able to take that. If you want to take a mini position, say a size of 0.1, you must have at least $10,000 or pounds in your account. If you want a position of 0.01, you must have at least 1,000 pounds or dollars in your account. That's what it means. I will show you, because sometimes people may not be able to have this amount of money to be able to trade this size. I will show you how you can still trade that, even though you don't have up to 100,000, but you can still use this and still make money. Because in currency form, what that one standard lot means is that you're taking $10 out of that account to be able to trade that position. You're taking $1 as for a mini out of that account to be able to trade. You're taking 1 cent from your account. Sorry, this should have been 10 cents, not 1 cent. 10 cents. I would correct that. I normally don't correct things during the class. So, but this correct. You can correct this in your notes. It's 10 cents, not 1 cent. Now, I'll take you to the position here so I can show you what I mean. Now, if you look at this, I'm trying to trade this, for instance. Say I take a position. Let me look for one position. See this one. Let me open this chart up. I'll show you how those standards, those numbers come into play, how we determine them. So if I were looking at this right now, looking at this chart after I've analyzed it, I'm saying, okay, the way I see this chart, maybe I think this thing is going to keep going up. You know, maybe I've done my analysis, I've looked at different parameters, and I'm telling myself, or could this be an opportunity for me to sell? Okay, I decide, okay, because based on the strategy I have, I think maybe this thing might come down. Let's just say, I think it might come down. I decide to enter the position. I can decide to use 3 different sizes. Those sizes are what the stake I'm putting into the market. If I put 1 in there, that's like me putting this thing in the market, putting $10 out of what I have. So this one represents $10 of my money. So I need to have enough money in my accounts to be able to do that. $10. Sometimes it could do 20, it could do 30, it could do 50. So, but just know that 1 means 10, 2 means what? 20, 3 means 30, 4 means 45, means those ones are called standard lot sizes. So it means you are taking whole numbers from your account. Now 0.1 means $1. So 0.2 means $2. 0.3, the same pattern. 0.01 means 10 cents. 0.02 means 20 cents. You see the difference now? You know, so 1 standard lot size means $10. So let's assume I'm coming here. I've said I want to buy. Is it sell this position? Let me just sell this position. I can sell this position at 10. What's it called? Look at how much I had. My equity was let's say my equity. This is how much I have at stake now. My equity is 45,037 pounds, euro. So now, if I decide to sell this position, let me sell it. If you see what happened, look at what happened. My position has reduced, my money has reduced, equity has reduced. You know, and because I put a standard lot size in there. So this means that now look at how much they are charging me some money because I have already put a standard loss. I don't want to confuse you, but just know that you can put sell positions with standards, minis, and micros. If this thing goes in my favor, you know, a certain amount of what they call pips, like I told you earlier, it means that I'm multiplying that 10 by the number of pips that it goes to. I'm multiplying that 10 by the number of pips it goes to. I'm not going to confuse you with this class, this session, you know. Just know that there's something called lot size, there's something called pip. The way it starts to come together, you would see them at a later stage. But I just wanted to show you that is how you enter with lot sizes. You can enter with 1. I can also enter with the other one that I talked about, 0.1. That's me entering with how much? $1. I can also enter with 0.01. 0.01. That's me entering the market with 10 cents. You know, that's me entering the market with 10 cents. You know, so and also it also depends on certain other parameters which I will show you as we progress. So that's that one for you to have at the back of your mind. Just know that lot sizes are your position sizes, is what the stake that you put in the market to be able to trade. You know, and when the market moves in your favor at a certain pip, by a certain pip, which we treated earlier, if it moves by a certain pip, it means you're going to make money. If it goes against you also by a certain pip, it means you're going to lose money. But we'll treat that in this next one. Now look at that. You can gain or lose for each movement, which is affected by the size of your position. So now we want to calculate how much you can make, you know, by using lot sizes and pip, putting those two into consideration. There's a formula here: position size times the number of pip that has moved. Position size and the number of pip gives you the the monetary value. I take you to a note. Let's say, for instance, now let me look for a note. So let's say, for instance, I want to trade. I remember what I told you about this positions. There's £10, $10, or £10, 10 naira, whatever that you have as a currency for one standard lot. So let's say I took a position of one standard lot. One standard lot meaning that I'm going in with $10. Yep. So, and maybe as I enter the market now moves maybe like 10 pips. It moves 10 pips. So it means I'm multiplying that my $10 by 10 pips, which will equal to how much? 100. 10 times 10 is 100. So it means that this is how much that one standard lot size, or let me just put it there, one standard lot size. So that is what that one standard lot size has made me. For that particular position, I entered maybe, let's say, Euro USD, for instance now. Euro USD, and what was I doing to the Euro USD? I was selling. I sold Euro USD. What happened there? No? So I sold Euro USD, and I sold it for one standard lot size. One standard lot size means that how much have I put in the market? $10 is what I'm taking out of my account. Let's say I had 1,000, or let me just say I had $100 account. I had $100 account, and now decided to take $10 out of that account to trade the market, to sell Euro USD, and the market now moved 10 pip. It means that I have made $100. So $100 plus my $100 that I have in my account, I've already grown that account to $200 by just the market moving 10 pip. If the market now moves 20 pip for me, guess how much? That's $200. Or maybe for some reason I know how to trade so much, the market move $100, 100 pips for me. This is number of pips, by the way. I trade and I was so blessed in the market, and it moves 100 pips. That's $1,000 that I have made just in how many hours of trading. And because I was able to enter a standard lot size. Now, if I entered the same vein, if I entered with a 0.1 mini, I told you mini, that's this other one. This one is 0.1. Mini is called 0.1, which is $1. That's how much you're entering the market with. 0.1 mini lot size. Mini lot size. Again, don't be confused. Don't worry about if you don't really understand it. It's okay. When you start using it, it will all come together. But just listen through as I continue. So what are you entering the market with? $1. And if the market moves 10 pip, how much do you think you're going to make in the market? You're going to make only you're going to make only £10 or $10. Yep. If the market moves 20 pips, it means that you're only going to make how much? Same way, 20. Let me put pips here. It means you're going to only make 20. Why? Because you're only multiplying one by the number of pips. If it moves 100 pips, like the other one moved 100 pips, how much are you going to make? Only 100. You see? So because you used 10 pounds or $10 to enter this market, when it moves 100 pips, you made 1,000. So if you use £1 or $1 to trade this market and it move 100 pips, you will make only 100. Why? Because 1 times 100 is how much? Is 100. So the next line is 0.01, which is the smallest one that we use to trade, which is called the micro lot size. Micro lot size. Micro lot size. What does that mean? It means that you're only entering the market with 10 cents. That's how much you're entering the market with. So 10 cents now times, let's say 10 pip. How much is that? That's only how much? That's only how much? That's $1, isn't it? That's only $1 because you're entering the market with only 10 cents, isn't it? Now, if the market moves, let me put pips there. If the market moves 20 pips, how much are you making in the market? Only $2. If the market now moves 100 pips, like we said the other one, if the market moves 100 pips, how much are you making? Only $10 in the market. So you see the difference. So it means if you have a higher stake in the market, you will make more money. If you have a lower stake in the market, you will make less money. But then for you to be able to make this higher stake in the market, to enter the market with $10, you have to have a large account. You can't have, let's say, you can't have $100 account, because that's too high, because I can give you why that is not advisable for you to have $100 account size. Let me put that, account size. I didn't want this class to be more technical, but it's fine. It's fine as long as you learn something by the time we finish. So if you have $100 account size, yeah, and you enter this market, let's say you use $10 to enter the market, and the market only moved, let's just say it moves only 10 pips against you. It doesn't go in your favor. It goes 10 pips against you. How much do you think you're going to lose? That's your entire account. You've lost that entire account. That's what they call blowing accounts. I know you will get to hear what that means, to understand what that means, because when you start trading, I promise you're going to blow a couple of accounts. If you start, unless of course you start with demo. Even with demo, you're going to blow a lot of demo accounts as well, just to be able to understand, because it's all about practice. You need to make mistakes. If you don't make mistakes, you can never learn. So just know that you will make a lot of mistakes. That's the only way you can learn. So if you enter with a standard lot size of $10, and the market moves only 10 pips against you, you've blown that account. You've lost that account, because it's going to take all the money that you have. So you wouldn't even be able to pass this 10 pips. It can't go to 11, because you don't have the money to pay the broker for. So it will only stop at where your account size can handle. So, but let's say you had a £1,000 dollar account. So if the market goes against you 10 pips, what does that mean? It means you have lost $100. Yep, meaning that you still have how much left change? You still have 900 left in these accounts. So now if that market goes against you, like we said before, 100 pips, how much have you lost? You've blown that account. That's the end of your $1,000 accounts. So that's why we advise you to, if you have account size of this size, don't go here yet. Don't start trading with this kind of figure, with this lot size. Start with something like this in this area. Start with these areas, these lot sizes, this small 0.1, 0.01. Because those ones, you're using that to practice, you're using that to build your account up. You don't want to put in so much money, you don't want to risk too much. You just want to take part of your money and put in the trade. I don't know anyone that does a business and maybe like they have a budget of 200, for instance, or 200,000, for instance. They spend the whole of that 200,000 on a particular area. Maybe you want to run a restaurant, so you spend the whole 200,000 just buying food. Well, where are you going to get money to buy the other equipment, the chairs and the fridge and all of those things? So you spend part of that money to be able to invest in the market, so that when you're able to make returns, you can increase it, which is how we trade in here. But I will show you all of these things. You'll get to understand. You see how they come together when the time is right. So that is how, this is what I was trying to explain. So one standard lot, 10 times 10 pips, price movement against you will be 100 pips, $100 loss. One standard lot size, 10 pips, $10 times 10 pips, price movement in your favor means you're making $100 profit. That's basically what that is. The summary of that. But like I said, when we do it together again in the real market, it will come together. So now, one other thing I wanted to mention is the concept of leverage. Now you will get to understand this eventually. Leverage is what the broker gives to you to be able to trade the market, because you are not able to conveniently jump into the market with an account. Like if I come into this business, there's no way I'm going to put $100,000, or where am I even going to get $100,000 from to start trading, Because for me to be able to trade, let me take you back to where I was showing you. For me to be able to trade a standard lot size, this standard lot size, I need to have at least $100,000 in my account. For me to be able to trade a mini of 0.1, I need to have at least $10,000 in my account. For me to be able to trade a micro, I need to have at least $1,000 in my account. So you see how impossible it will be for me to be able to do this. But that is where the broker's leverage come into play. The broker would require you to, that's why you see here they have something like 1 to 100. There are places you have 1 to 50, 1 to 200, 1 to 500. So what the broker is simply saying is that for every $1 you bring in, the broker will give you an additional 100. You know, they will give you leverage, what they call support. They will give you support to help you, to give you maybe some money that a part of the money that you need to enter that market. That's what it really means. Now, mind you, that money that they are giving to you is only a borrowed currency. It's not like when you make money, or maybe like they give you 100,000 to trade with. It's not like when you make money, all of that 100,000 belongs to you. No, the only thing that belongs to you is the profit that comes out of it, or the loss that comes out of it. Meaning, if they give you a leverage of maybe like 100. Okay, let's say 10,000 for instance. Right now, you enter the position, and the position goes against you. I mean, goes in your favor, 10 or 20 pips, and you get 200, for instance, $200. That money belongs to you. But it means that you are just able to enter the market because with just an ordinary $100, you can't trade the market. You need the broker to be able to help you trade the market, because they will be able to supply you the currency that you need, the amount of money that you need to be able to trade. So when you enter the market with your $200 account, the broker will support you with a leverage of maybe like 200,000, 500,000, which is what you need to be able to take a position. So when you make a profit, if you make a profit of 100, that 100 will come into your $200 account, increasing your position, your account to 300. If you make a loss of $100, that $100 will be taken out of your $200 account. So just see that a leverage as an opportunity for you to enter the market, because your account size may not be big enough to be able to take a particular position. Again, all of these things are things that you do not need to cram. You don't need to know them to the letter. It is in use, like something like leverage. You don't even need to have a full understanding of how it works. What you just need to know is that you don't take too large a leverage, because if you take too large a leverage, it's like somebody borrowing you money. The more they borrow you, the more you are likely to pay a higher interest. Put it that way. So it means that you can lose the money easily when you borrow too much, because you have a tendency to want to spend it, just want to spend it. So just know that you don't over borrow. When we start trading with us, when we start guiding you, we will show you the leverage to choose. We'll show you the what you need to do with your broker, and what positions you need to enter so that you don't lose your account. So don't need to cram anything. Just know that what the leverage is. Leverage is what the broker gives to you to be able to support your position. It's just to be able to help you to be able to take a particular position, maybe a standard position, a mini position, or a micro position. Yep. So that's what leverage is. Now, there is the concept of bid and the ask price. Now, this information, when you travel, for instance, abroad, there are currencies. You maybe went to say back to Nigeria. You went to Nigeria, for instance. You have to convert your dollar to the naira when you get there. So there's a price that those at the airport or whoever the exchange agencies are would change the money, that your $1 to you. There's a price that they will change to you when you want to change. Now, when you now come back to the US and you want to change back your money, when you get to the US, those exchange agents, there's a price also that they will change your Nigerian money to you, or you might even want to change it from Nigeria before coming here. There's a price they will change it for you. So those are called the bid and the ask price. I take you real quick to the chart again, because all of these things you find in the charts. Now look at that position I just entered earlier. See, I was selling. What did we see? You see, it's increasing in value. You see? So I'm making £3.40 or €3.40. This one too. See the difference? They are all, see, for the standard, see how much I'm making. For the mini, see how much it is. And see for the micro, see how much it is. You see, so this one is increasing. I've already made like up to 8, almost up to 8 now, $8. I mean €8. This one I'm still making maybe like €1. This one I'm making like 0.1. So it means that if you have a standard position, you make more money. If you have a micro position, you make lesser money. If you have a mini position, you make lesser money. So that's just by the way. Now, if you come on here right now, let me look for Euro USD. That's our base currency, the one that we like to treat. If you look at this, this is the ask of the bid price, and this is the ask price. What does it say? It said the bid is the price at which the market or your broker will buy a specific currency pair from you. Thus, at the bid price, a trader can sell the base currency to their broker. The ask price is the price at which the market or your broker will sell a specific currency pair to you. Thus, at the ask price, you can buy the base currency. Now, I'll show you what that means. Now, let's say I'm here right now. I come here. Remember, this is where this information is where we click to place in and call it place an order. I come here. I want to buy Euro USD, or let me say I want to sell Euro USD. Euro USD will be say a trader can sell at the base currency to their. So you see the price that they are going to quote to me is the bid price. If I click this right now, it is this price that is going to show what. Okay, I put the wrong currency. Sorry, this is what I want. If I click this, it is this price that they are going to sell to me. They are going to sell this. They're going to give to me or specify or give to me at. If I buy, this is the price that they're going to give it to me at. Let me press it now. So you can see what I mean. If I click that, you see. You see the price they gave it to me at. Okay, some very very close to the price that we saw there. You know. So that's what it is. Now another thing is this again. Don't be so concerned about the bid and the ask price. What you're much more interested in is buy or sell. Buy or sell. Am I buying? Am I selling? And why am I buying and why am I selling? It means that you looked at the market and you say, okay, I see this market is about going up. So in that case, I need to buy. Okay, you look at the market and say, I think this market is about going down. Then you sell. So don't really bother yourself about the bid and the ask price. The only reason to look at the bid and the ask price is because that will determine your transaction costs. It is the difference between the bid and the ask price that determines your transactions cost, which is also called the spread. We will look at that eventually. The spread is very key because this is how much the people will charge you, the brokers will charge you for this particular position. They charge you, let's say 1.7 pip, you know, for them to be able to trade this position for you. But that you will find out more about it in when you start trading. So don't really bother yourself about that. So bid and ask price are just prices that you sell or buy the market at. That's this information. Okay, that's the chart that shows it. When you buy, this is they give you at the ask price, and when you sell, they give you at the bid price. We've seen that happen. The spread exactly is the currency pair varies between brokers and is difference between the bid and the ask price. It is also called the transaction cost. This is how much the broker charges you for the position. Like I said, this is how much they charge you, which is the difference between the ask price and the bid price. Like we say, if you make this right now, if you subtract this from this now, you see it falls into this. Subtract this from it, this is what it falls into. But don't really bother yourself about the bid and the ask price. This is what is really key that you need to look at. This information here, they are all there, so you don't need to make any calculation. They've done everything for you. So just look at it and say, oh wow, the spread on Euro USD is quite high. Okay, it's not as high as the spread on Euro AUD. Okay, let me look for trade in Euro USD. So it means that I won't be paying so much compared to if I was going to buy GBP chef. This is almost 40. So I will not look to buy this one or sell this one because it's quite high. I will be concentrating on the ones with the smaller pairs. So another element, remember when we treated broker, how to choose broker, one of the things that we looked at is make sure you look for brokers with smaller transaction costs. And FinPro, the broker that I was telling you about that we use, have a smaller transaction cost. Look at, for instance, that Euro USD that we looked at earlier. Look at what happened. Look at how much they are selling it. 0.1. But you see how much these guys are selling theirs, 1.8. Or less, so it shows 18, but it actually means 1.8. But this one is 0.2, 0.1, 0.2, which is really, really small. So what it means is that if you take a position now, you will not spend so much money to be able to make profit. But if you take position here, you will spend a lot of money to be able to make profit. Why? Because you need to pay them this one first before you make your profit. But this thing information, like I said, is just, it might seem a lot. You don't need to cram it. Just know that when we start trading, these things will all come together. They will all come together. Is what we call the type of orders. Now, if you notice what I did in market when I got here, what did I just do? I clicked on the pair, I double clicked it, and what did I just do? I just click sell, I click buy. I click sell, I click buy. That's an example of what they call the market or instant order. Market order. So what did they, if you see here, you see market execution. What that is what it means. So you just click it at once. So the type of market order is called market execution. It's written here. You click it once, you click it once. So you're entering the market at the prices that you're seeing. You're selling at this price and you're buying at this price. That's what it means. Instant or market execution. When you use your phone will say instant execution. Some people's phone, yeah, some, I think I'm thereabout, will say instant execution. Some will say market execution, but it's the same thing. So it just means that you're buying at the market that your price that you're seeing. But that we'll do at a later stage, so to show you more how that comes into play. Then pending orders are the orders that you place. This is where that one is. When you click on this information, you go here, you see pending order. See pending order. Under that, there are different other ones that we will treat one after the other. So this one simply means that you don't buy immediately. You just pick a price and tell the market when the price comes, enter me into the market. Let's say I want to buy this thing. I say, for instance, this is where I am. This is where I want to enter the market at this price. Excuse me. Let me delete this. Let's say I know that this market is going to go up eventually. If you look right now, you see a number. These are the prices. If you see here, this is a price. If you see here, this is a price. So I can do what they call an order. An order. Instead of just buying at that price, I can just put this price out, telling the market when the market comes, this movement, when it moves up and comes to meet me at this price, then you can enter into the market like what you have seen here. But if it doesn't come there, don't enter me yet. For instance, now if I put this information and say 0.88780, this is the price I want this to happen. I call this maybe like a buy stop, for instance. So I'm telling the market I'm going to enter this market using my 0.01 lot size, and I want to enter the market at this price that is here, not at the current price, because this is what the current price is. You know, I want the market to go up a bit so that when it comes to that place, I would continue to buy because it's coming up. Remember, I said when market is coming up, we are buying. So when I enter that price and place, oops, sorry, my mistake. So 0.88780. Am I making a mistake there? Okay, let's see again. I think I must have made a mistake or something. Let me see. Okay, so I'm saying that when the market, if you look at it, unlike what happened here, when I click buy or sell, what happened? It entered at once and it started counting money for me, either loss, because when you see minus, that's loss. When you see plus, that is gain. So what did you see? It stayed here. It had nothing has started counting yet, because I'm telling the market just do a pending. Don't buy or sell yet. You know, just do a pending order. In order. Like what you see here, don't buy or sell. So it's going to keep it at the back. So when this market comes to meet that price, it will enter me into the trade. So if I change my mind, I can always delete it. Click and delete. So I won't even lose anything. But right now, it means I'm going to I'll be making 19 or 18 pounds. That's how much I'll be making. If I close this one right now, it means I'll be losing 21p. Sorry. I will be losing it 21 cents or whatever. So that's what that one means. If I close this position that I have now, if I click this and close it, that means I'll be making 124 euros. You see, because this account is in euros. If I close these other ones, it means I'll be making 80 euros. If I close this one that I just entered now, that means I'll be making 20 euros. You know, but all the minors that you see here are all losing position. So if I close this one, if you look at here, see what it means. This is my balance right now. This is how much my balance is. But this is my equity. My equity means that the money that I still have here plus my balance. So if you add all of the money that I have here into this equity, into this balance, this is how much it's going to come to. If I close all of them right now, this is how much I'm making, 226 euros. If I add it to this amount, this is my balance. This is how much it's going to come to. So that's what this price thing is telling me right now. So that's what pending order is. It says that I'm going to put my order in place, but don't enter me yet. Wait till price comes to that price. So pending orders are placed in advance with the belief that the future price will react in a certain way. And we have the different types. One of them is the limit orders. Limit orders meaning when price comes, price is going to come down and bounce off a place and then jump up. Buy stop order means price is going to come up and meet my price and keep going up. Sell stop orders, price is going to come down and keep coming down. Sell limit order, price is going to come up, meet my price and bounce back down. Like I said, these things are much more practical than theory. You know, they are much more practical than theory. So it's just that when you pick up an order, you want to do a pending order, you go to pending order, then you select whether you want to do a sell limit, a buy stop, or a sell stop. All this we will treat when we come to start trading. But so don't really worry yourself about that, but just have the idea there's something called a pending order and there's something called a market execution or instant execution or instant order. So with that comes to the end of the session. One other wanted to mention real quick, which is very key, is the concept of the stop loss. Stop loss is what protects you from losing a position. Let's assume I enter this position, Euro USD, and I'm losing. I would put what they call stop loss. If I bring stop loss, I'll put my position stop loss somewhere around here. I will say, okay, I'm not sure this market is going to keep going up, but just in case, let me say, okay, because I'm buying, I'm going to put it here. So I'm not sure this market is going to keep coming down, but just in case it doesn't come down and it goes against me, I know I'm going to lose money, but I don't want to lose money too much. So I would only maybe want to lose only $5. If it goes against me, please take me out when it gets to $5. If it goes in my favor, it's fine. Don't take me out. Keep me in the market. But once it goes against me, take me out at $5. That's why what they call stop loss. Stop loss is just supposed to stop your loss so you don't over lose your position. Because some people can be in the market, maybe you went to sleep, you left your trade open, went to bed. By the time you came back, all your money is gone. Why? Because the market went all the way against you. Maybe 100 or 200 pips, and that wipes your account out. So you put your stop loss there to protect you. Stop loss, like I like to call it, is an angel. It protects you from a loss. You know, so that's the concept that I didn't put in this particular section, but I will treat that at a later stage. Okay, so that brings us to the end of this session. So I will take question now. I will just put the class and take questions.